So welcome everybody. We are here with a really special guest today, Mr. Stephen Van Metre, otherwise known as the Bond King. The Bond King is present today and he's going to share us all of his insights and expertise surrounding financial markets, the overall economy, and it's really, really a pleasure to have you here, Stephen. You have your own website, you have a tremendous audience surrounding you. So thank you for coming on.
Max, it's really, the honor is all mine. It's fans like you that make all this possible. And like I said, I was really looking forward to being on your show today.
Great, great. So why don't we just get right into it?
Yeah, let's do it.
So right off the bat, let's talk about the dollar.
Okay.
So we've been seeing obviously a tremendous, not tremendous, but a pretty significant downfall in the US dollar. Specifically, the DXY has been trading under 90 handle. So it's looking bearish for deflation bugs, if you will. However, people that are considering deflationary outcomes are still not biased, but they still have reasons to consider deflationary signals and whatnot. So can you go into more about why we're going to face deflation? Why we are currently too?
Yeah, it's kind of interesting. You look at the dollar, it's been what's called range bound for the past 5 years. And just recently it's trending near the lowest point it's been at 5 years, as you mentioned. And it, really the story of the dollar didn't start until March, where we have this belief that somehow quantitative easing and stimulus is going to generate a weak dollar, even though no one remembers that quantitative easing started back in October of 2019. But nevertheless, so what's going on is you see the dollar declining. There's a lack of demand for dollars in the United States, and my view on that has been, when you send people home from work and then when you bring them back at the same time, but if they're not making payments on their loans, I mean, so you think about, as a consumer, what is my demand for dollars? Mostly, well, it's going to be debt service, right? Most people have a mortgage, a car payment, and other bills, credit cards, student loans. Well, those are things that you need dollars for. And if you didn't, if you don't have any debt, your need for dollars is generally less than someone who does. And that isn't really a popular view, but what has, come from that is you've seen the dollar weaken, relative to the euro, and it's just brought in a lot of people, speculating and selling and trying to short the dollar lower. Now, you kind of wonder, well, why would they do that? Well, there's a nice inverse relationship, generally between tech stocks, particularly, and the dollar. And in fact, since March, you can almost, draw a chart of, stock market, and you put a mirror there, and then you see the dollar inverse to that. You see things like gold and gold mining stocks, which are very popular right now on the inflation hedge or trade. And then of course you see crude oil and Bitcoin, and all these things really do well when the dollar weakens. And yet one thing that I find real interesting, Max, is when you look at the consumer price index and you overlay the dollar, you would really expect to see a big increase in consumer prices due to the weaker dollar. In fact, you're not seeing that at all. So it kind of makes me think of, okay, well, if the dollar isn't creating the inflation, but it's creating asset inflation, there's a problem here. And it's more of a symptom now of not only lack of dollar demand from the crisis, but what we're seeing is a shrinking global economy. And we're seeing the mechanisms that move dollars out of the United States into the foreign economies, into the euro dollar market. They're not working. They're not happening. And so while everyone's beating this drum for inflation, what I look at is the relationship between dollars and the bond market. So what do we see? Well, we see there is a relationship between treasury bonds and the dollar. And when bond prices go higher, dollar usually follows. Or if the dollar is leading, then you see bond prices go. So where one goes, the other goes. So what we have right now is bond prices, which are relatively high. I mean, I know a lot of people think, bond prices are really low, but if you look at relative to their all-time high, they're actually fairly high. And you see the dollar's been weakening, and you have what's called like an alligator jaw, where they're going apart. Well, what it tells me from a macro perspective is one of them has to be right, and the other will eventually play catch up. So the question is the dollar right or is the bond market right? And then I have to come back and say, well, obviously being the bond king could create some bias there. But what I look at it is, what is the whole purpose of quantitative easing, and what is the Fed up to? Well, they're buying bonds. Okay. Well, what are the commercial banks doing? They're buying bonds. What are, foreign central banks doing? They're buying long bonds. So you see the three biggest players in the market are buying bonds. And then you start to examine what quantitative easing is. And all it does is it reduces the duration risk of a commercial bank asset down to effectively an overnight asset or cash. And you really start digging in and you think, well, wait a minute, quantitative easing is removing dollars from the system. So effectively what the Fed's trying to do is raise bond prices and strengthen the dollar. And that tells me that I can still be bullish on the dollar from a macro perspective, even though, since March, it's gone down.
So does it matter how much colossal debt this sovereign will incur? Does it matter? Is there a limit to how much debt a sovereign can have? I mean, I know we've seen the same even before America. We saw it with Japan, but is there a risk of seeing, whether it's a short-term inflationary spike in consumer prices, or kind of what we're seeing now in asset prices? Some can argue that's inflationary. Some can argue that's pure sentiment built around, a variety of different things. But is this colossal debt, a benefactor of inflation or deflation?
Well, it's kind of interesting because you've got two questions kind of there. Let's come back to the debt one and talk about, we're seeing this asset inflation, right? We're seeing higher asset prices. And there's this belief that, okay, well, if home prices rise, if stock prices rise, and commercial real estate prices, all these things rise, that'll have to be turned into inflation, right? Because, I'll go and withdraw home equity from my house and go spend it in the real economy, and everyone else will. And next thing you know, there'll be, greater demand for goods and services. And yet we continue to come back and look at the consumer price index, and on a year-over-year basis, it's rising because it's positive, but it's rising at a slower and slower rate, and it's not recovered. So you would expect that all of these increases in asset prices should tell you that inflation's coming, unless of course it means that nobody's selling or extracting that equity out of those higher asset prices, which they're not, and spending in the real economy because they believe asset prices are going to go higher. So I look at this and say, yeah, you're right. There is an absolute disconnect here. And the dollar is just creating asset inflation. It's not actually creating consumer price inflation, which is, of course, a big problem for the Fed, which will keep them doing QE for a lot longer. Now, in terms of your question, is there a limit to how much debt? And the real answer is, I don't actually think there is. Of course, it's the effect of the debt. What do you get? You get an economy like Japan, and what does that mean for America? Well, there's a number of charts you can do where you can take the federal government and you can debt and you can invert it, and you can see the velocity of money slows down. So money moving through the system is like molasses. It moves slower and slower and slower. Well, that's deflationary. And then you can invert it and look at the labor force participation rate, and you can find out the more government debt there is in the system, that means there's fewer jobs. And I've been one of the few people that have said is that, coming out of this pandemic, there are going to be fewer jobs. And it's not just because businesses are failing, which is an unfortunate side effect of all these lockdowns. It's because the massive amount of government debt in the midst of a very limited or dollar shortage, where there's not a lot of dollars out there, means the federal government's appetite for those dollars is great. It's huge. Well, they're just taking dollars away from the regular economy, from the private sector that could use them. Well, it means there's fewer jobs. And then, of course, you can also look at it in relation to the interest rates and find out that, more government debt, despite popular belief, does not lead to higher interest rates. It leads to lower interest rates, again, for the same reason the government, it just has this massive volume of an appetite for dollars, and that is taking dollars out of the hands of the private economy, which is where inflation is created, right? When, consumers or businesses go out and borrow money, that's where money is created. Well, if you limit how much money the private sector has, well, then you're effectively going to limit inflation.
Right. Makes sense. And so with this colossal debt, right, it's supported by suppressing interest rates left and right. So is that really the primary thing that is supporting this colossal amount of debt that's, just increasingly colossal?
Yeah, I mean, there's belief that, okay, low interest rates are, you know, byproduct or causing more debt. Really, it's the debt that is causing a suppression in interest rates because there's too much of it. I mean, if you look at what, how you create inflation, you actually need a society that doesn't have a lot of debt. So the more debt you get, and this is real obvious, as you mentioned earlier. I mean, you can just look at Japan. I mean, they have a massive amount of debt, and interest rates are at zero, and there's just no chance. I mean, every chance they've tried to nudge those rates up, it just doesn't work. But yet here in America, we have this weird belief that somehow debt in America is inflationary, even though nowhere else in the world it's nowhere, it's not inflation anywhere else in the world, and nor has it ever been here. I mean, so you look at the last 40 years and you see this massive increase in debt, and what do you see? 40 years of decline in interest rates, 40 years of, you know, declining consumer price index. And so, yeah, I look at all this and I say, well, you know, history shows that it's the sheer amount of debt that's leading to economic malaise.
Okay, and speaking of history, what I find interesting is if you go all the way back to the Federal Reserve Act of 1913, would you say that act is kind of a symbol that, all right, well, the Fed is essentially an independent branch of the US government. So they're kind of, I don't want to throw the word delusional monetary policy, but maybe it should. Is that maybe the reason why the Fed Act of 1913 was created initially? So
You know,
that,
there's lots of reasons. I take a very simplistic approach to, you know, how the world works. You know, obviously, if we had my friend Jeff Snyder on here, he'll give you, and I'm sure someday you'll have him on your show where he'll give you by far a more technical reason for it. But if you just go back and look at the history of central banking, they were there to do two primary things. One is to, you know, deal with bank failures. So that was a common problem where, you know, they needed a central bank to deal with, you know, runs on banks because, you know, JP Morgan was tired of bailing out the banking system. And if you look at the construction of the Federal Reserve Act and the Fed itself and what they were trying to do, they were never concerned. I mean, if you look back in history, deflation was not a problem. I mean, you can read all the history books you want, and you'll never find a society or a country that was like, man, we just had this problem with persistent inflation. Like we couldn't get rid of it. No, in fact, you run into the exact opposite problem was, you know, inflation would occur and would get crazy and the currency would become worthless. And then, you know, citizens will lose faith in it. And then you have runs on banks and banking failures and so on and so forth. So what you see is from the Fed standpoint is you have a system created, the reserve system itself to not be inflationary because they never thought that like, hey, well, we're going to give the Fed all the tools it can to fight deflation because we never, ever expected to be, you know, in a secular deflationary environment. And that's where we're at now. And that's why when people are like, okay, well, the latest Fed, you know, tool or, you know, acronym or whatever they're going to use, that's going to be the one that creates inflation. But if you really dig into the act and the Federal Reserve themselves, is they just don't have the tools to create inflation. And yet they keep trying. And I give them a lot of credit for that, but you know, it hasn't worked.
right. And it, from what I understand, the Fed only has, they can only do two things, which is raise or lower the Fed funds rate or the monetary base. But I mean, throughout the March lows till currently, you know, the Fed going out buying corporate debt ETF, I mean, corporate bond ETFs, junk bonds. We won't even get into the Swiss National Bank equities outright. So how are we as just normal investors or even people just going to jobs every day, how are we supposed to keep up with this, you know, the Fed just doing new things on each occasion of a disaster, let's say? How are we
Well,
supposed to keep up with them?
we're really not supposed to. I mean, the whole idea of the Fed is that they're supposed to be the silent hand in the markets that we're never supposed to even know. I mean, there was a time that no one actually cared that it was an FOMC meeting. There was a press conference. It was a non-news event. Today, everyone around the world, if you're an investor, you care about what the Fed chair is going to say, what monetary policy is going to be. And that's just a sign to us that, hey, it's not working. Of course, as you mentioned, the Fed encroached into, the corporate bond market and the high yield bond market. And just as you probably know, with the passage of the recent stimulus bill, some of those powers have been taken away and some of them were set to expire. But it just goes to show that the Fed is desperate. I mean, they're trying to stop the deflationary effects. And that's something a lot of people don't understand is they think, well, quantitative easing is inflationary. Well, when you really look at it, the only reason they're doing quantitative easing is because of the deflationary forces that are in the system right now. They're trying to combat them. And, so quantitative easing itself isn't inflationary, but it can get to become inflationary if you can get interest rates down low enough, which is, as you mentioned, there's two ways to do that. One, you lower the federal funds rate. Well, we're at zero, so you can't really go below that. At least my understanding of the Federal Reserve Act says they can't. And then you have, okay, well, what else can you do? Well, you can do quantitative easing, which raises the monetary base, as you mentioned, and that's exactly correct. And what does that do? Well, that means they're buying, bills, notes, and bonds, depending on what the program of the QE says they're going to do, or what they say they're going to do. And as they buy those bonds and take them out of the market, the idea is that brings interest rates down and bond prices up. Well, you bring interest rates down low enough, hopefully you can get consumers and businesses to go out and borrow money to spend on things that they weren't ready to. So you want to pull, the idea is to pull at what's called aggregate demand forward. How do I get, Steve, who, may be buying a car in 2 years, to go buy it now? That's kind of the idea. And what do I have to do? Well, if I can get interest rates low enough, maybe he'll do it. And that's the idea.
Okay, so, and I remember reading about this very briefly on Twitter. Might have been from Bianco Research, if you're familiar with them. But anyways, I believe it came out that $1 trillion worth of treasuries are supposed to expire at the end of this month. And then within the year, around 15 trillion, I believe $6 trillion is to expire within the year of 2021. So is it going to be the case where, all right, well, and big tech owns $250 billion of treasuries. So when they're forced to unwind, are they going to buy more treasuries, or what's going to happen?
Well, I did see that post, but normally what happens is people just, when the debt matures, they generally just buy more. They just, keep the ball rolling. It's kind of, think of it like I have a 6-month CD. I put $10,000 in it. And at the end of 6 months, I could cash it out, but if I don't need the money, then it just renews. And the idea is the same with this. A lot gets made out of the fact that debt is maturing. And what the Treasury will do is they will take some of that maturing debt and push it out toward the longer end of the curve. That's a normal event. And then they'll just reissue the debt, again. And usually people come back and buy it. I think there's plenty of demand for Treasury debt, as we've seen, especially considering the Fed's removing supply. So we know the banks need T-bills. And, some of this that was expiring was due to the CARES Act. So some of that money that they had built up in the TGA was set to expire. But now that we have this stimulus bill, a lot of that will get spent on that. But as far as the remaining debt maturing this year, it should be really nothing.
Okay, so nothing it is. And
well, it should be. I mean, it should be a non-event. I mean, the idea, some people say, well, no one wants the debt. Well, go look at the auction data. There's no evidence at all, none, that says there isn't demand for this debt. If there wasn't, we would see it in the auctions today. And then there'd be a really big concern. Hey, all this debt is coming due and nobody wants it. We're seeing just the opposite.
And I remember one time watching your macro show. Stephen actually has a weekly macro show he does 3 times a week, and it's growing crazy. Everybody loves it, and it's the most educational channel I've probably ever used, which is great. So, but what I remember watching is, the fact that primary dealers are, it corrects me if I'm wrong, they're buying, there's just no stopping them. And the indirect bidders too, they're not only keeping up with demand, but they're just, they are what's creating the elasticity. Am I correct in saying that?
Yeah. So there's 3 major players treasury auctions, and there's really actually two, as you kind of pointed out. So let's get rid of the one that doesn't matter that much. It's called direct bidders. So they are, inside the U.S. So people that are directly bidding at the auction, they're usually the smallest player at the auctions. The second largest one, which is one a lot of people focus on, are foreign bidders, which would be your foreign governments and foreign central banks. There's always a lot of interest in what's going on with them. And the reason simply is if they're buying at the auction, that means the global trade cycles are working. Now, we do know that they've been biasing toward the longer end of the curve recently. We have seen, over the last 18 months to 2 years, they've been, letting some of their treasury securities roll off as they mature. So they've been actually seeing their size in terms of how many treasury securities they own shrink. Now, a lot of people think, well, that's really bad. That's higher interest rates. No, it actually doesn't mean that at all. It means the global economy is deflating. And, the reason you see foreign central banks and foreign governments accumulate treasury securities is because they accumulate dollars through global trade. So as those dollars stack up inside their country, because they're fiat, they become inflationary. Well, how do you tamper those effects? Well, you convert them into treasury securities, which become a savings account, right? Because I can either sell them if I need money, or I can just wait till they mature and then I can get the cash. And that's exactly what they do. And then the other big player, or usually the biggest one, I think, as you mentioned, is primary dealer banks. Now, a lot of people think the primary dealers are buying treasuries to hold. That is not the case at all. They are dealers. So think of them like a retailer. Retailer does not stock inventory because they want to hold on. They're like, hey, this is free. You can come shop, but you can't buy that, or that. No, I mean, that's not what dealers are doing. Dealers buy at auction to resell for a profit. Now, some of that we know is being sold to commercial banks, which are many commercial banks own primary dealer banks. And why are they doing that? Well, because commercial banks are selling them to the Fed as part of quantitative easing, but there's also a demand for treasury securities. So what dealers are doing is they're buying them at auction, and just think of them as a buffer. I mean, rather than having a 30-year auction every week or every day, they're just doing one a month. The dealers want a lot of this supply because they need it not only to feed the Fed, but because there's demand out in the market. And so they're just a buffer to that issuance. But yeah, there's plenty of demand out there, as you mentioned, if you look at the auction data.
Okay, great. I don't want to take too much more of your time here, Stephen. So I'm just going to wrap up with, we'll wrap around to the dollar, and I just have one more little special question. And so going back to the dollar, I remember reading on Hedgeopia that the net shorts on dollar contracts is the most it's ever been since 2011. And so the amount of bears that are entering into the short side of the dollar is immense. But I mean, they can't stay shorts forever. I mean, right, once a seller becomes a buyer and a buyer becomes a seller, it's just a marginal trade-off. But people don't really seem to understand that it's just a one-side bias story, but eventually it has to turn the other way, right?
Well, I mean, that's the great thing about markets. There's always two sides to the story. And what you're seeing, you see not only in dollar shorts, which I'm sure you're referring to the most recent Hedgeopia report from this weekend, or from Friday, which was posted this weekend. Then you look at the treasury market, which you see these massive shorts, especially on the long run. It's just a bet on inflation. I mean, if you came to some, a professional money manager, or, such as say a hedge fund, and said, look, I can promise you inflation's coming. What's your easiest bet? Well, they're going to say long-term bonds. I'm going to short them, and then I'm going to short the dollar. I mean, so all you're seeing is them playing the positions that make sense based on what they think. The problem is, as we've discussed, is my research into quantitative easing says they're going to be completely wrong and eventually squeezed out of those positions, where you'll see not only interest rates collapse, but you'll see the dollar rally. And if that happens, you're going to see what is going to be a replay of the great financial crisis, where you have the consumer price index go negative. And that will be just a massive wrecking ball to the equity market, to gold, to commodities. I mean, it will be disastrous. But that's the setup you're seeing, is because everyone's betting, this massive speculative bet on inflation. Well, so far we haven't seen it, but they keep increasing their bets on it. If they're wrong, well, then we'll have to come back and talk about how I got that call right.
That's funny. So, and then speaking of safe havens, that was my last question for you is Bitcoin. Obviously, the mania around Bitcoin is extraordinary. Everybody's piling in, even institutional money is coming in at a pretty rapid pace. So will this trend continue? Will people actually start to realize that? Now, me personally, just so we're on the same page, I'm actually a Bitcoin bear. I don't believe in its intrinsic worth. I don't believe it has any. That goes for its use value too. It's just Bitcoin. That's all it is. But with all this money flow going into it, can we expect the same thing as we saw, what was it, 3 years ago, 2017? Just as quick as it went up, it'll go straight back down like the bubble it supposedly is.
Yeah, that's my expectation. I don't own Bitcoin. I've never owned it or any cryptocurrency. I kind of have a rule. One, I don't buy anything that I either can't eventually buy from my clients. So if I'm buying, I'm doing it just to see, get a comfort level with it. But it's not a registered product, so I can't invest my clients' money in it. So I haven't touched it. I do watch it, as you know. But yes, so what happens during insolvency events, and what is an insolvency event, is where, I have a mortgage payment due or a car payment and I don't have enough money. It's musical chairs, but Steve's finances now, right? I have to pick, do I feed the family? Do I pay the water bill? What do I do, right? I've only so much money. And during insolvency events, people will reach to places where they can get money the fastest. And where will those places be? It will be Bitcoin. And that's why you see gold sell off, because, let's say I have a few gold coins. I don't, but let's just, pretend I did. I could go sell those pretty easy. They're liquid. So my expectation is we will see a pretty large reversal in Bitcoin, but it'll be the same reversal we see in the equity market. I mean, if you look at how Bitcoin is trading, I mean, that's really all you can do, because I don't know what it really is either, but we do know it trades like a tech stock and it's largely inverse the dollar. Well, if you get a dollar rally, which will then spell the end of the equity market, then likely direction for Bitcoin would be lower. Now, does that mean if it, takes a big drop that it can't, come back and then make even bigger highs? Well, I'm not saying that at all. I'm just saying when you get a negative CPI and inflation adjusted interest rates, or real yields is what they're called, when they start rising sharply, it just destroys risk assets. And maybe Bitcoin will get through it. I don't know. I mean, I think that's really the big question everyone is really asking right now about Bitcoin. Some people are willing to put a lot of money on that. I'm not one of those. Maybe they'll be right, and I'll be happy. I'll be one of the first people to come and say, wow, cool, great. It's an asset class we now understand a lot more about, or we're going to find out that it is a risk asset like other asset classes, and it'll come down. But I don't know.
Right. People buying into that fund, Grayscale, at what, a 35% premium to net asset value, doesn't make too much sense.
Well, I'd argue this whole market doesn't make too much sense.
I concur. So, Stephen Van Metre, everyone, would you like, before we head off, would you like to tell our viewers where we could find your information, how we could enter your macro show, all this amazing stuff?
Yeah, I think if you could put a link to the macro show, it's Mondays, Wednesdays, and Fridays, and on YouTube. And then, of course, there's a Sunday chart show. And you can find me on Twitter. It's pronounced more accurately than it's spelled, at Metre Stephen, Metre, even Stephen. You can find me there on Twitter. I'm pretty active there. And yeah, I'm out there. So you can find me wherever you look.
Great. And of course, I'll have all your information down below on the description of the video. So Stephen Van Metre, thank you so much again for coming on. It really has been a great pleasure talking with you. And I've learned so much throughout just this little duration of us talking. So thank you so much.
Well, Max, I appreciate you having me on the show, and I appreciate you being a fan, and I appreciate all of your fans for being fans of my show as well.
Great. Stephen Van Metre, everyone. Happy holidays, Stephen. Have a good one.
Thanks. You too, Max.
Thank you.